Hi, everybody. This is Dan Sheridan. On a beautiful day, Tuesday, December 14th, the day before the big Fed meeting. That's the big thing on the markets mind right now. How far will market watch says? How far will Powell's new hawkish tilt go? Fed meeting, stock market ready for faster taper. So anytime there's an event coming up, what happens in the market? People are a little nervous. Today SPX is down 52 points at 46.16. But if you look at a chart, as we're going near the 50-day moving average of 45.86, we're about 30 points from there, which isn't that much. But again, without all the Fed stuff, is it unhealthy for the market to back off a little bit? Yeah, I mean, we're still 120 points off the all-time high in the history of civilization since Cleopatra. So what would I be looking at today? What are some principles that you should use for trading when, hey, there's an event that can move the market? And the other thing, VIX is up a couple points today. We are at wherever we're at. VIX 22 and a quarter, up almost 2 points today. So what are some principles as we're going into a Fed meeting? You could say trade smaller. These are some principles we use here at Sheridan Mentoring. Trade smaller. Further out duration if you're doing some type of trades. Further duration. And again, always, you got to have a risk management plan, right? Or while you're going out in the boat, good risk management plan. Now, could you stay out until the news comes out? You could. I mean, if you're looking at the market, we've been in having some turbulence in the market since generally probably beginning of September. If you look at this piece here, 5% move down, 6-7% move up. You got some good, as the pilot would say in the cockpit. What does he say? Oh, we're going through a little chop here in Denver, Colorado, ladies and gentlemen. Please stay in your seats. And that's what you're getting, a little bit of chop. So how do you handle that, right? A pilot might handle it by going down to an altitude, right? That's more comfortable. So how do traders handle that? Do they hide under the bed at every move? No, not every move, maybe every other. So three ideas here for today. Dan, you're giving 3 ideas. You're darn tootin' I am. All right, first one. On a down day, down 54, VIX up a couple points, I'm looking at a put credit spread. Dan, are you stinking crazy? A put credit spread? Do you understand what? Yeah, well, let's take a look at it, my friend. January 21 is what we're going to go to on the put credit spread. Give you 3 quick ideas. If you want any more information, check us out, SheridanMentoring.com. We have some new on-demand classes and some new classes coming up in January. But if you look at January 21, so we're going out January. How many days are we going out here? We are going out January 21, a little more duration. So we're going about 38 days. 38 days. It's like a warmer blanket in the winter if you're in the Smoky Mountains, right? So here we go. So with SPX about 46, 15 area down 53, I'm looking out to January, 38 days or so, sell about a 20 delta put, kind of the right number for me to get a decent yield, but have good probabilities. And in this case, I'm just doing a 20 wide put credit spread. And it's going for $2.50 credit. Your margin would be $1,750. So you have maybe a potential 15% yield at expiration. I'm just using Thinkorswim here. Here's the underline at 46.15, and you can see the short put 43.10. It's already in Buffalo, New York. You got a lot of room, over 300 points. But here's what people don't always understand with these put credit spreads. If you look at the deltas here in SPY, I'm one delta long. You know, this isn't like a covered right or cash secured put, you're more delta. So I like this. We've got good duration, good room, keep the size small. And if you want to wait till the event's over, that's fine. But I'm just looking, three things that look interesting to me today. All right, number two, Dan, give me number two. You got it. Number two, a broken wing butterfly. All right. For beginners, this may be a lot for you, but another strategy that would benefit if the volatility went down, and VIX is up today a couple points. So this is January 21. We'll keep that duration theme about 38 days, 38 days, 8. Easy for you to say, 38 days out. And we're going to sell near the at the money 46.20. And we're going to do the 46.85. So I would call this a broken wing butterfly. Here's the underlying 46.14. We're selling the 46.20 strike. We're doing all calls. Again, that Jan 21 expiration about 38 days out. But you can see when the distance between the short and the lower strike call is 70, and the distance between the short and the upper strike call is 65. I call that broken wing or unbalanced. Why do I do it? To get your position deltas a little closer to zero. That would be the reason to do it. And that's where we're at now. And this is a good range bound trade. In a higher volatility environment, we get a little more room. It's another trade I'm looking at. And then the third one, giving you, throwing everything at the kitchen sink on you, looking at, if you can look beyond today, looking at a stock like Microsoft, a decent stock, and you look, today's a pretty good down day, down 4% or 13 points. It's right taking lunch on the 50-day moving average here. And if you like this with a little bit of a long-term approach, today I would consider a poor man's covered right. We call it in the options world a long diagonal. So I'm going to go out to March 18, buying in the money, 290 call as a stock surrogate. You say, why would you do it? Much cheaper, so I can get better yields on this potential. Selling and going a little over 2 weeks out and selling it out of the money, slightly out of the money, 330 call, going closer to at the money. It's a down day. What if we go down, right? And this is going to cost, well, you say $37.73. Dan, you say that's a lot. Well, if you did a covered right, on a $32,000 stock, it's going to cost you like $37,000, over $30,000. So would you rather spend $30,000 dollars on a covered right to maybe try to get 1% or $3,700 and look for 7 or 8%? It's a lot cheaper, right? And again, you look at the graph. Here's where we're at. Here's where we're at in Microsoft. And you can see the short strike is up here at 330. This is your expiration graph. This is your graph today. And we're about 34 deltas long. So these are going to be longer deltas than like the credit spreads. But you can see this is the graph at expiration. This is the graph today. And you can see, it's like when you leave in an airplane, that ascension up, right? That's what you'll like with these covered rights. When it's descending, that's when you want to probably roll out the short strike. But these are three ideas: Microsoft long diagonal, SPX put credit spread, and butterfly that I'm looking at today with a little bit elevated earnings coming into the Fed announcement today. Check out our website, SheridanMentoring.com. Have a great day. This is Dan Sheridan. We'll see you later. Thanks.